Today's topic is how to choose the right insurance. First of all, I'll also like to introduce about myself. I'm Ashish. I have been a part of Pickright, and we are mostly into portfolio sales. We as a company do not sell any insurance, but we feel that there is lot of need among all the investors and people to know about insurance and how to buy the right product for them. So our initiative is to educate all the investors, and we'll be doing it in a series. So today we'll be only starting with the basic of insurance. What are the type of insurance, why, how to choose a insurance, those things only. Later on we'll keep on adding, like going to the detail of a particular product, going to the performance of a particular product, going to the suitability of a particular product. So this will be a series that will keep on coming. We'll also telling you how to do KYC, how to fill the form, and how to choose a particular plan. And in case you have any queries or anything, you can ask on the chat box. We'll be replying you, and you can also reach out to us over email or whatever mode of connection you want to like. So let's start what is insurance. First we'll learn what is insurance and how it is important to all of us. So for most of us, we do not know what is insurance. We feel that insurance is just a product or a financial product which only make or we use to take it as an investment. We feel that we can invest into insurance and get return out of it. But in particular, insurance is not a return generating product. It is a product which make good your financial losses. So what is a financial loss? So let's say you have a car and you meet with an accident. Then you have to go to the garage and get it repaired. Whatever cost you have to incur, that is called financial loss. So there will be a financial loss in case somebody dies. So when somebody dies, it is a loss not to that particular person, but it is to his family. So whoever is his family member, they will be facing or incurring a financial loss because they will be closing, or one source of income is getting closed for them. So what does insurance do? Insurance basically help you to cover your risk and lower your financial losses or remove your financial losses. Most of the time we feel that we buy insurance only to generate some return or generate wealth. It is not the case. Insurance is basically a product which is designed to make good your financial losses. We should not consider insurance as an investment product, but of course there are a lot of products which is available from insurance which can be taken as an insurance product, as an investment product, but you have to understand that whether it is a need to yourself, whether you really need that product, then only you can go for buying this kind of products. We'll move on. So every insurance has certain principles. So every insurance product is designed on these principles, and these has to fail. Most of the time people complain that why to buy insurance because I do not get any claim, or they do not pay the claim. But there are certain things which we need to know before you put a blame on somebody else, that why insurance companies doesn't pay your claims. So most of the time the main principle of any insurance is utmost good faith. So when I'll be going to an insurance company and I'll be asking that you insure myself for 1 crore, then insurance company asks me certain questions. How is my health? How is my parents' health? How is my job? If I'll be telling everything truth, then there will be no problem. But only thing is, in case I surprise any of the information, or if I do not tell any particular information to them, then it will be a concern to the insurance company. When there is a claim and somebody says that no, I was not a smoker, and it is found that he was a smoker, then only insurance company will not make the payment on that particular claim. So that is called utmost good faith. So whenever you fill the insurance form, you make sure that you fill it yourself, or else in case your advisor is filling it for you, you be with him and see what is getting filled. then only these kind of scenarios will not happen. Second is insurable interest. When I go and do some insurance, I have a personal interest into it. In case I cannot justify an interest, then I cannot take a insurance. For example, a husband can take an insurance on his wife's name, but he cannot take an insurance on somebody else's name because there is no interest. In case that person dies, as an individual, this person is not going to get affected anyway. So there should be an insurable interest. So let's say you have a car, then you can only take insurance for your car. You cannot take insurance for somebody else's car. So that is called insurable interest. Next is indemnity. So as I told you earlier that insurance as a product makes good your financial losses. So what is a financial loss? Let's say you have a car of 7 lakhs and it met with an accident. Then the insurance company mentions something called IDV, or at the max it is the value of the car. So your claim on the insurance company can never exceed the value of the car or value of the insurance declared value or insured declared value. So that is the indemnity you have to give all insurance company, that your claim can only be up to that particular limit. More than that, insurance company doesn't pay. Then there is something called contribution. Most of the time you will come across that people has taken 2 or 3 insurance on the same product. That is not always required. Maybe it is a useful tool when you go for a health insurance, because once limit of one health insurance is over, you can consider taking your claim from the second insurance or a top up insurance. But what does the principle of contribution tells? Let's say I have a mobile which I have insured for 10,000 and I have taken insurance from 2 different companies and I go on and put a claim. When I put a claim, let's say company 1 pays me the claim amount, it can go to company B and ask that, see, I have settled this claim and I want some portion of it. So that is one principle of insurance which is called contribution. Next is subrogation. What is subrogation? Subrogation is nothing but, let's say somebody is driving a car and he met with an accident, but the accident is not done because of his mistake. It has been done by somebody who was doing a drink and drive, or somebody who is a minor and driving a car. Then insurance company will settle your claim, but it will also put a case on the third party or the person who has done the fault, who was driving either without license or under the influence of alcohol or anything. That is called subrogation. So contribution and subrogation both are different. One should not get confused with that. Then loss minimization. What is loss minimization? Is insurance is a tool which will minimize your loss, but you cannot make a profit out of it. So insurance is not a product for making profit. So let's say you go to you have a house and which got fire, and you are not putting any efforts to save your house from burning and everything is getting destroyed, and you go and claim that my house is 1 crore, you give me a cover of 1 crore and I have some utensils or some electronics inside and those are another 20-30 lakhs, you give me 2 crore. But insurance company is going to give you only up to a limit of 1 crore, not anything more than that. So that is called loss minimization. Third is cause proxima. So cause proxima is nothing but what is the reason of the damage. So let's say if a damage is happened because of accident, then insurance company will pay the claim. But in case the damage or the accident has happened because you yourself was drunk and driving, or you have been involved in some other activity which was not legal, then that causes insurance companies will not make you any claim payment. So we have to remember these 7 principles of insurance when we go on and buy an insurance product. In this particular webinar, we'll be talking more about the life insurance. Slowly we'll go to the products. In next episodes, we'll go to general insurance, we'll go to health insurance, we'll go to other different kind of claim settlement processes. All that will be informing you. So let's move on. In insurance, what we cover is a risk. So what is a risk on any individual's life? On any individual lives, there are only 2 risks. One, either he will be dying very young, Second, in case he'll be living very long or longer. So when somebody dies young, then his family member loses the income or loses the earning member. Then it is a loss to the family. Insurance can make good this financial loss. They can never make good the emotional loss that family goes through. The other problem is living longer. So living longer means we all will work to a certain age, maybe 60, 70. Everybody cannot work up to 80, 85. So all of us has to take a retirement sometime. When you take a retirement, after retirement is a period when you do not get any salary, get any income, and you have survived on your savings. So that is the problem in living longer. So in case somebody lives very long and his savings are very low, then he will not be able to survive or sustain his retirement for a longer duration. So Pickright takes care of living longer problem for you now. So at Pickright you can come and do a lot of investments in different asset classes, like be it gold, stocks, mutual funds. But insurance is a product which will needed by all of you, and it will be helping the problem in case somebody dies very young, because he has not worked for these years to build his wealth. So now coming to types of insurance. On a common perspective, insurance is divided into two. It is life and general. But for better understanding, I have made it life, health and general. Health insurance is also a part of general insurance. Today's topic will be talking more about life insurance. So life insurance is a product which can be taken on a particular individual. Nowadays you see some of the product which has come up, and it can be taken with a spouse, or joint life is possible in today's era. Second is health. Health plans are basically family health plans or group plan. It can be taken on an individual basis as well as a group of family or group of people it can be taken. And general insurance covers anything. So you want to insure your laptop, you want to insure your car, you want to insure your house, everything can be insured under general insurance. So life insurance is for human life, health insurance for your health, and general insurance for all other products. And all these insurance are very essential to individual. In case somebody do not have any insurance, then he has a risk that he may lose out his savings in case of emergency. Let's say somebody who do not have a health insurance and he gets admitted to some disease. Nowadays hospitals are too expensive. Some of the diseases will be costing you 20 lakhs. So if you put that much amount, then all your savings will fade away. So that's the reason every individual should have a life insurance to cover the life uncertainty, health insurance to make good the financial losses. General insurance will also, it is important you protect all your assets so that it doesn't give you a pain at the time of any eventuality. So moving on to type of life. What is a life insurance? Let's understand what is a life insurance. So life insurance is a contract between a policyholder and an insurance company. So all over the world, insurances are basically a contract. It is not a product, it is basically a legal contract wherein you and your insurance company come into agreement that I'll be telling all the truth and this is my risk, you cover my risk, and you tell me that you promise me that you will be giving my nominee 1 crore rupees or 10 crore rupees in case I die. Then insurance company will do its calculation depending upon your risk profile and come up with that this is the premium I'll charge for this much sum assured. So let's say you pay a premium of 10,000 and I'll give you a cover of 1 crore for next 20 years, 30 years or whatever. So there will be different plans available now. So when we go to plans explanation, probably we'll be discussing that. For the timing, I'll be just telling what is a life insurance. So it is basically a contract where there is a fixed sum assured is given to the nominee in case of a death. So what are the types of insurance? The first type of insurance is term insurance. Term insurance is a pure protection plan. Let's say you pay premium, you get a cover. In case nothing happens to you, the insurance company is not going to give back anything. This is the cheapest plan, but in India this is the plan which is not been very widely utilized by most of the customers and investors. Second plan is traditional plan, which gives you protection plus savings. So we as individual always look for that a plan which can protect us. At well, it also generates some return. In term plan, let's say you pay 10,000 for 20 years and nothing happens to you. Whatever 2 lakhs you have paid, you are not going to get back anything. But on a traditional plan, you will be getting a protection plus a return. So what is the return? The return on a traditional plans are very low now. Earlier, if you go to your parents or somebody who has taken the plans much longer or much olden days, they used to generate a return of 10-12% or some of the time 8-9%. But now the traditional plans will be giving you a range of 4 to 6%. The best plan could give you 6%. The worst plan can give you somewhere around 3-4%. So in that way, you can choose that what is the need of going for a traditional plan. Why do most people buy a traditional plan in India is because they feel that whatever I pay I should get back and it should have a return, so that way I can be on a safe position and it is a good product to me. So some people have started complaining that the returns in a traditional plan is low. I want a product wherein my protection will be there, at the same time I'll also be getting a return or I can generate my wealth. Then ULIPs has been developed, and ULIPs has been developed in somewhere around 2000-2002, and it has been very popular those days, and now also they are also very popular. Many people invest into that. You can also consider investing into this depending upon your risk profile and the need or the financial goal you have. On that basis you can choose this plan. So we'll go to the detail of the plan and at the end we'll do the analysis. So what is a term insurance? Term insurance is nothing but it is the most common product. It is a simple and easy to understand insurance plan. You pay me a fee, I'll give you a cover. You tell me truth, I'll adhere to my promise. If you hide any fact, then I may decline your claim. If you look at today's date, most of the insurance company, be it private and public, all of them are settling their claims on a percentage of more than 90 to 95% in terms of number of policies. So you buy any insurance company, any product, most of the claims are getting settled now. The important thing while choosing a term insurance is you should see that what is the premium you are paying, what is the history of the insurance company, whether they are settling the claims on time or not, what is the service affordability, whether at the time of need the insurance company is available in your locality to get the service easily, or else your nominee or persons has to travel to different cities or something to get the claim. So you look at whether it is available, what is the convenience. Some of the insurance companies do not cover certain kind of people or certain kind of geography they do not cover. So you have to look at them and choose the most cost effective ones. It is not that a cheaper one will not be giving you a claim. That is a wrong notion that most of the people have. A cheaper policy is also going to give you a claim. The only thing is, while filling the form you have told the truth. Then all the insurance claims will be paid, because IRDA regulates this, and IRDA does a very fantastic job on regulating all term insurance. They have come up with some new plans or new policies in 2014, wherein in case somebody has misquoted or misrepresented a fact and continues the policy for 3 years, in certain cases they settle the claim. So we can discuss that when we have a webinar on the claim settlement. We'll discuss that on detail. So this is basically what a term insurance is. You pay a premium and you get a cover. So what are the benefits of term insurance? It is easy to understand. It is very cost effective. It can give a very high cover. So by paying 7,000-8,000 also you can get a cover of around 1 crore, where in traditional plan the maximum cover possible is whatever premium you pay into 10 times. In certain child plan and all there will be some exception, but mostly it will be 10 times the premium amount is the cover amount. But in a term insurance there is no such limit. You have to have a minimum income of 3 lakhs, then you are eligible for a term plan. Some companies has also come up with a term plan which can be given to a lower income group. So you can check the product policy, product details and decide on. So term insurance helps you in case there is a eventuality. So let's say you have taken a plan and the person who has taken a plan, he dies because of some eventuality, then his family is going to get a lump sum amount. There will be different variants available in term insurance now. Earlier it was only sum insure. Now they have come up with insurance plus income or only income, different varieties. So when we'll have a webinar on pure term insurance, I'll be also explaining you that what are the different kind of features we have within the term insurance, which term insurance is ideal, and why we should not invest into the other one. All that I'll be explaining you. And if you look at India's data, most of the people are uninsured. If you go to an urban area like metros like Bangalore, Mumbai, you may see that 1 out of 5 is insured. They have taken some insurance. But if you take the data from pan India, and if you go to Reliance, they never thought of any term insurance. They only know that there is a money back or endowment policy. I pay the money and I get back the return. That is the only product they know. They never heard of term insurance. So that is the problem, that most people do not know why they need a term insurance. And when we go and tell that you buy a term insurance, then they feel that what is the fun in it, because it is a loss of money. Now I'll not be getting anything. So that is not the case in case of a term insurance. You should buy a term insurance. Now let's move to traditional insurance. Traditional insurance is the choice of India. Most of the Indian people have invested into this product, whether on their will or by the influence of some of the relatives or of some of the friends. But everybody has taken some or the other way some traditional plan. Traditional plans are basically two plans. They are basically endowment plan and money back plan. There is a very good advantage of traditional plan, that let's say you have a goal and you want to send your child for a foreign education in next 20 years. So in a traditional plan, the advantage is you say that I need 20 lakhs after 20 years, and you keep on paying a premium. Whatever it may, you are going to get that 20 lakhs. Whether the policy gives a low return or high return doesn't matter, but you are going to get 20 lakhs. The advantage is this is a product which is going to give you certainty. So when somebody has a goal which is almost certain and he has time to his advantage, and he is a very low risk person, he doesn't want to take any kind of risk, then only traditional plans are good. But I'll tell you, the compounding that happens on a traditional plan is very low, because when I give you guarantee, when I give you assurance, then I'll also giving you a low return. Like we get low return on a fixed deposit and we get high return on a mutual fund investment. The reason is FD returns are secure, mutual fund returns are linked to market. So in that way there will be a market risk which will be linked. On traditional plan there is no market risk. Whatever is the scenario, the insurance company is going to pay the premium. In case there is a closure to an insurance company, no insurance company in India can close the business and run away. They have to transfer all the plans to some other insurance company, or some other insurance company has to buy the plan. So IRDA has put strict guidelines so that customer doesn't have to suffer in case any insurance company closes down tomorrow. So all those problems has been well taken care by IRDA, and that's the reason probably traditional plans are most popular in India. Most people invest it, and all the agents mostly promote this kind of product. And the advantage is these plans are also starts with a very minimal investment. Some plans can even start at 1000 or 2000 rupees a monthly or quarterly investment. So what is a traditional insurance has? It has risk cover and it has savings. When I say savings means it is only going to save your money. It is not going to maximize your money. So it is going to give you that protection on your life and protection on your money. The value of money may not come down, but whether it will be able to beat inflation or not, it is not certain. In some cases it may, in some cases it may not beat inflation. And some people who are having a higher tax bracket and all, they may get some advantage out of a traditional insurance plan. What is the problem of a traditional insurance plan is it is very complex to understand, because there will be lot of conditions which only when an advisor explain you properly you will be able to understand, because most of the time you only been told that you pay 20,000 for 20 years and you get another 40,000 for next 20 years. To you it looks like it is a fantastic plan, that I am paying 20 and I am getting 40, my money is getting doubled. But you have to look at that the money is getting doubled in 20 years, and 20 years is a very long period of time, and the annualized return or the compounding rate is very low. Then comes the ULIP. ULIP is the plan which is being... Hello everyone, now let's continue with our program. So we have been discussing so much about insurance, what is insurance, type of insurance. We have already discussed term insurance and traditional insurance. Now let's continue it. What is ULIP? So what is a ULIP? ULIP has been designed for all of our need of building wealth. So everybody loves to win. So as a user or as an investor, I always think of that in case I get a plan wherein I can cover myself as well as I can maximize my wealth, then there is nothing like it. To serve that purpose, insurance companies started producing a product which is called ULIP. The concept is very new in India and it started somewhere in 2001-2002. And what does this product does? This product makes you or gives you an option to cover your risk as well as help you invest into different assets. It could be stocks, bonds, gold, whatever you want. That is how the ULIPs has been designed. And this product has gone into lot of transformation in last 20 years, and today it is a very good product with very minimal cost. Initial days it has come with a lot of cost, like lot of placement fees, so people were not able to generate any good return out of it. So IRDA is very kind on this part to all of us, and they have taken this very seriously. They helped all the investors as well as insurance companies to streamline the product and mature this product, and we see the form of a product which is very good and very useful for many of the investors. So let's continue to what are the advantages of ULIP. Sorry. Advantages of ULIP is it is a market linked product. When I say market linked product, means it will be investing into stocks or bonds or gold which is listed into the market. That is how there will be lot of transparency. You know where your money is getting invested, what is the kind of return you are going to generate out of it, and how your money is also growing. Second advantage is this product can be linked to different kind of goals. So what is goal based investing? A goal based investing is nothing but let's say you have a goal of child education, or you want to go for a holiday trip or abroad trip or retirement. That is a financial goal. So ULIPs can be a very helpful tool in achieving your different kind of financial goals. It also gives liquidity. Liquidity in the sense this product has a lock-in of 5 years, and after 5 years if you want you can exit the product. But I will not suggest you to do that yourself. Consult an advisor, consult your insurance company and see whether it is a wise thing to do, because there will be many plans wherein when you exit you may have to pay certain charges for exiting the plan, and there could be some tax implications also. So you understand that and then only decide on the liquidity or liquidating your unit-linked insurance plan. Flexibility to choose from different fund options. So this product has very different kind of fund options. It has equity, it has bond, it has gold. So whenever you feel that no, my markets are very high and I want to switch between, you can switch also, or depending upon your risk tolerance level you can select a fund. Either you select a debt fund, equity fund, or you can choose both. Depending upon your requirement you can select. Next is the charges. Charges is a drawback of a ULIP plan. So this ULIP plans comes with different charges. So you have to go to a IRDA advisor or SEBI or IRDA licensed advisor who can help you to understand the plan, who will tell you that what are the charges that you are going to pay for this particular plan, and depending upon that you decide the plan which is suitable to you. Low life cover, this plans generally give a life cover of 10 times of your premium. Some plans with available at 20 times or 40 times, but it comes with a cost, so you have to pay some extra premium to get higher life cover. And mostly child plans will always have a option to give you a higher life cover. Lock-in period, so if you look at any other investment products, this product still has a lock-in period of 5 years, which will be always high for many investors. So as we have completed this, now let's discuss about what are the difference or what are the conclusion we can draw from this particular presentation. So the idea of the presentation is making sure that you understand what are the type of plan, whom they are suitable for, and then decide. So now let's start with life cover, which is the most important part of any insurance plan. And when we choose a plan, we always look at what is the kind of life cover we can get from it. So when it is a term insurance, your life cover is always high because you pay a very small premium of 10-20,000 and you can get a cover of 1 crore or 2 crore, and it will be for a longer time, and within the period there will be no change in the premium price. So on that way, term insurance is a very good product. When you think of traditional plan, the life cover is low. As I told you earlier, the life cover is only 10 times of your total premium. It will not be more than that. Some plans may give you 20 times, but on a general terms it will be 10 times. So the life cover is very low, and you sell out a very high premium for it. And ULIP also, the life cover is low. The ULIP and traditional, in both the cases, the life cover amount is 10 times or 20 times of the total premium you pay. Coming to the charges, which is highly significant in many plans, but in term plan the charges are very low. But most of the time we do not think that it is a charge. We always think that the charges are a very huge expense, and we tend to avoid a term plan. We feel that why to invest in a product which doesn't give us any return. But if you look at the charges of a term insurance is very low. And I have also told you in term insurance that a charge doesn't define whether a product is good or bad. In case you have given all your data correctly to your insurance company, as soon as you receive the policy document, you have read it, and insurance company has also printed all your details properly, then you do not have any risk and you can get your claim. Next is traditional plan. Traditional plans charges are not very clear, that there will be no breakup that how much they will be charging for mortality, how much charging for admin. So they will be only giving you that you pay 10,000 for 10 years, and after 10 years you will be getting 20,000 or 25,000 for next 10 years, or you are getting a whole lump sum amount of 2 lakhs, whatever is the policy terms and condition. On that basis you will get a sum assured. If there is a bonus, you will be eligible for getting a bonus, but you do not know what are the charges. The only thing is there will be some surrender charges, there will be some other charges which you may able to understand from the policy document. But while taking the plan, it is always better that ask your advisor to show you a policy document. All the insurance companies list their policy document on their website. You yourself can go and read it. In case you do not find it, then ask your advisor. They will definitely help you to understand the policy document and what are the charges incurred in a particular traditional plan. ULIP also has, they declare what are the charges they do, though the charge structure is a bit complex. What they do is they charge you admin fee, placement fee, mortality charges, and there could be some charges when you do switches, or some charges when you ask for a statement. So you have to look at what are the charges which are involved in a unit link plan. If there is any charges in case you pay additional amount or do not pay for some years, or you opt for a premium or holiday. So charges structure in a ULIP is a big one. So you have to be very clear and understand what are the charges which are involved in it. See, there will be no charges which will be hidden. IRDA has made it clear that all the charges should be available to all of you, and it will be clear on all the policy documents. But some of the time we do not take a interest to know whether it is the thing we should know. We generally do not ask our advisor that what are the charges. So be clear on the charges. Liquidity, term plan has no liquidity. Once you have taken the policy and till the term, you have to continuously pay the premium. In case you do not pay, the policy lapses. And I'll advise you, never ever go for any policy lapses. And in case you think that a new plan is giving you a better product at a lower premium, it is always advisable you go and tell your existing insurance company that please close my policy. Or else what may happen is in future you may not get a claim. In certain cases you may not get a claim in case you have not disclosed that there is a term plan, but your existing term plan has already expired. So in that way it is important that in case you are closing a term insurance, go and always talk to your insurance company or advisor and give them a written request and take a acknowledgement that you have closed the policy. Traditional plans, there is no liquidity, but they have, some plans will have a loan option. So you can take the plan and take loan from it for your immediate requirement, and you can repay them as soon as your need is over. Or else there is no other option of liquidity in a traditional plan. You have to anyhow complete the entire term. There is one more option which is surrender, but surrender is not a wise thing to do because you will only get 20-30% of whatever you have paid in most of the cases. So it is not at all advisable. If you pay for longer duration, let's say if you pay for 10 years and your policy term is 15 years, then probably you will get somewhere around 60-70% of the total premium paid. So try to avoid surrender. There is something called paid up. You can go and make your policy fully paid up and you can reap the benefit of a adjusted sum assured. That is a wiser thing to do. I'll disclose or discuss that once we have a different webinar on all traditional plans. Unit link plans has a high liquidity, though it has a 5 years lock-in. After lock-in, you can anytime withdraw the policy. Some policies may charge you some 1%, 5% depending upon the policy document. You have to be very clear on that, and then only you can go for a liquidation of your policy. And some ULIP plans also give you an option of partial withdrawal. After 5 years, you can withdraw certain part of your fund value. So that option is also available. But in case you have taken a ULIP plan or a traditional plan which is linked to pension, then I advise do not go and blindly liquidate the policy. Always check with the advisor and your tax consultant that what are the repercussions. In many of the pension plans, in case you pre-close a policy or surrender a policy, you may have to pay taxes. So check it before you decide. Then lock-in in a term plan, the lock-in will be for the entire policy term. In traditional plan also there will be a lock-in of entire policy term. Only option is you can go and surrender the policy, but apart from that there is no flexibility. And in a ULIP plan, after 5 years you either can surrender or you can take partial withdrawal. Both are allowed in ULIP plan. It varies from plan to plan, so you have to understand the charges. Return, term plan doesn't have any return, and term plans are best because it is a product designed to cover risk, not to generate any return, but to meet somebody's requirement. Now many companies are coming up with term plan wherein there is a return of premium which is available. So whatever premium you have paid, that entire amount will be returned back to you at the end of the policy term. So in case you have taken a policy for 20 years and at the end of 20 years the policyholder doesn't die, then entire premium whatever he has paid will be returned back to the policyholder, or else it may be given with some interest. It could be 5 or 10%, not more than that. In general it will be 5-10% interest, or only the principal amount which will be returned back to the policyholder. In case of a traditional plan returns has come down now. Earlier, if you go to maybe 90s or early 2000, then some of the traditional plans used to give 8-9% or 10-12% return also. But now it has come down very drastically because at the end they'll be going and buying long-term bonds, and the bond price has come down, then so the policy return. So on an average you get somewhere around 4-5% of return, and it also depends upon the bonus they declare. So all traditional insurance plans declare a bonus. So when we'll be having a webinar on traditional insurance plan, we'll discuss more in detail about bonus. Then the ULIP. ULIP returns are always good because those are market linked. But as I told you, you have to look at the charges. So let's say you have taken a ULIP where the charges is, let's say, by paying admin, motility and everything, it is coming around 8-9%. Then on the first year, whatever premium you pay, the real investment is 90%. And market gives 10% return and you have paid 10% charges, then that particular year you do not generate any return. And market continues to perform negative for 2 years, then probably your returns will be in a negative compared to the market performance. So that's the reason charges plays a very important role on ULIP. And looking that problem, IIDA has come up with different plan options and helped insurance companies to set up different products where the charges can be minimized. There are products available only at 1 to 2% charges. So those are a very good product because 1 to 2% charges, no capital gain. It's makes out to be a good product. Then tax benefit. All the insurance plans has a tax benefit which is under ATC. So 1.5 lakhs per annum will be tax free under section ATC, including all your tax products. Like it also includes, the ATC also include your equity link saving scheme, PPF, NSC saving, whatever it is, or government fixed deposit or 5-year lock-in fixed deposit, everything put together. So this is a ATCL tax benefit that you will get on all term insurance, traditional and ULIP plan. Apart from that, in ULIP you get one more benefit, which is capital gain benefit. Let's say you invest into stocks or mutual funds, then you have, when you sell, you have to pay a gain or tax which is called capital gain tax. As your capital has appreciated, you have to pay a capital gain tax. The capital gain tax is in equity terms has been divided into two factors. One is short term capital gain, one is long term capital gain. Short term capital gain is somewhere around 15% and long term capital gain is only 10%, and up to 1 year is exempted from first year. However, in case you do a churning within a ULIP scheme, so you churn from a debt fund to equity and equity fund to debt, that will not be considered as a capital gain. Hence, you will not be charged any short-term capital gain tax or long-term capital gain tax. So, which is the advantage. So, people who has knowledge or whose advisor can help them, they can switch between different schemes and gain this tax benefit. Then comes objective. Objective of all insurance company is to give protection, or all insurance product is to give protection. But when you buy insurance, you should link your product or your insurance to your objective. If your objective is protection, protection means you have taken a loan and you do not want banks to bother you when you are not alive, that is, then you can go for a term plan. Let's say when you are not alive, you want your family to live happily with a huge corpus, then you go for term plan. So it protects somebody's loan or somebody's future income. It cannot make good the emotional losses, but at least the financial losses on your absence will be taken care by term plan. So that is why it is called as a protection plan. Traditional plans are for savings. So you put in these plans and you look for a fixed goal. So I'll tell you one more advantage in traditional plan is, so let's say you have a requirement of some your child education in 20 years. Now you know that how much money you are going to get in next 10 years or 15 years, and you can plan your expenses on that way. So that's the advantage of a traditional plan. It gives you an option of savings as well as insurance protection, and it can beat the return of a fixed deposit in certain cases after post tax, because you get tax benefit on this products. So if your requirement is protection plus savings, then go for traditional plans, and if you are looking for wealth building, then you go for ULIP and ULIP plans or market related product. So what is the advantage with ULIP is, you invest into stock market. So when stock market gives you better return, then obviously your money is to grow at a higher pace. So these are the comparison of all the products. All these products also come up with one more benefit, which is called 1010D. So 1010D is also a tax benefit wherein all the returns you get are completely tax free in your hand. So in case you invest in a traditional plan and you get a total sum assured plus bonus of 7 lakhs, the entire 7 lakhs is tax free in your hands, and you do not have to pay any tax or any TDS on it. In ULIPs, there will be also no tax on your withdrawal. All the maturity benefits are eligible on 1010D except a pension plan. So in case you have opted for a pension plan, then 1010D benefit will not be applicable. There could be some other plans wherein 1010D is not applicable. So you check before you make a decision of withdrawing or closing the plan, and on that basis you can decide whether there will be a tax benefit of 1010D is available or not. So, and our sincere request from Pickright is, whenever you choose for an insurance policy, you always opt for a IIDA certified person who is having a IIDA license, and read the policy documents before taking the policy. Either you can go for the policy brochure. All the policy documents are available on their particular website. You can go there, download. They are maintaining the policy documents on the version wise, like year wise. So all that you can download and check before you decide on a plan, and always buy it from a IIDA certified insurance advisor or insurance agent. So that is it for this episode 1, and the next episode will come up with the health insurance, because health insurance is one of the most sought product in these days. And if you look at after Corona, everybody is looking for a health insurance, and many people are looking for a health insurance for their senior citizen parents, and those are very expensive. So how to buy those policies, how will be safe, when will be taking a health insurance, and how to choose a particular health insurance, that all will be doing in our next webinar, which will be happening next month. So it will be more focused towards health insurance. So now coming to Pickright. So Pickright is a tech platform. It is a wealth tech platform. We specialize in building portfolios. We make smart portfolios for any user of any age, and these portfolios are diversified. It can invest into stocks, it can invest into bond, gold, and ETF. Some of our ETFs or funds or the portfolios has given fantastic return over 3-4 years. There are a lot of people who are looking for these kind of investment. As I told you in the earlier part of the presentation, that there will be two needs or two risks every individual has. One is the life risk, or somebody is dying young, and the other part is the retirement risk. So when you retire, you need income. So Pickright take care of that problem for you. So it helps you to build wealth on a very longer term, on a very economical way. In Pickright, you do not have to open any demat account or anything, or you do not buy any regular mutual funds. All the mutual funds here are direct mutual fund. Thus you do some savings. You can trade on your existing demat account. Let's say if you have a zerodha demat account, or if you have a 5 paisa demat account or Upstock demat account, you can directly log in via those accounts and directly do your trade, and all the trades will be done on a very smooth way. We have a different video available on how to trade on Pickright. So that video will give it as a link here, so you can refer to that video and install the app. Then app link will also be available on the video. So you can explore Pickright and start using our app. So this is our investor educational series videos. Will keep on coming with these kind of videos more often from now on. Probably one such video will come from us on every weekly from now on. So that is it, Pickright is about, and that is it from our side for today. So hoping to see you soon on our next webinar, and you will be intimated. Please subscribe to our channel. You will be intimated about the next webinar whenever it is happening, and definitely it will be happening by next week. Thank you. Have a good day and enjoy your day.